In a low-return world, the first step is accepting reality. The second step is making the best of it. I'm Jack Otter, editor of BARRON'S.com. I'm here with Brian Pfeifler, managing director at Morgan Stanley Wealth Management. You deal mainly with ultra-high net worth, I should say really exclusively ultra-high net worth clients. Let's pretend I'm your client. Sit me down and tell me what I should expect over the next few years in the markets.
Well, I think you would have already told me by now your individual situation, because I think everything we do is highly customized for each client. But I think I would say that we're in an environment now that is probably very different from the environment that many investors have faced over the last 20 or 30 years. And many of our clients are of the age where they have seen markets over an extended period of time. And by that I mean that an environment where cash is at 0%, maybe it's going a little bit higher over the next few months, maybe it's not, where 10-year bond yields are around 2.2%, and where inflation is running, let's say, around 1%, the likelihood of achieving returns that are consistent with what historical returns have been in the equity markets of, let's say, between 8 and 10 or 11% is probably not going to be as likely going forward, in my view, as it maybe is in the minds of some of the people that I sit down with. And I think that really a rational view of markets would suggest that maybe if the economy in the U.S. is growing between 2 and 3%, corporate earnings, given some leverage in companies, can maybe grow in the range of 4 to 6%, with a 2% yield on the current market at about 16 times earnings. My sense is that the equity market probably returns in the range of between 5 and 7 or 8%, looking forward for the next number of years. That's probably a lower return than I think many people would like to see, perhaps, and maybe are accustomed to seeing, certainly over the last 5 years, but even over a longer 20, 30-year period. So really, what I'm trying to do is set the stage in terms of, I think, a more sober view of potential returns in markets. Then obviously, with fixed income yields being as low as they are, the total return there I think is going to be quite lower than they've had historically. And then cash is really an asset class where maybe over the next year you earn between 0 and 1%.
So in that environment, what do you think the best way is to capture any upside, perhaps defend against downside, and just maximize their wealth?
I think if you can stomach the volatility, and by that I mean that you really don't have, let's say, over the next 6 months or a year, a pressing need to liquidate that portfolio, that you can hold this longevically for multi-years. I think that equities probably still will give you the best return, right? And I think that equities, in many regards, are the most tax efficient way to invest, and so that's an important consideration for many of our clients. But I think that equities, being the cornerstone of a portfolio, is probably not enough. I'm somewhat cautious on fixed income yields, primarily because the starting point for investment at 2% implies that you really have to have, let's say, a move down to 1% in yields to have an attractive mid to high single-digit return. I don't think that's going to occur. I'm very cautious on cash because I think that maybe it's at 0 now, going to 25 or 50 basis points. I don't see the Fed funds rate going to 2 or 3%. So one of the things that we've been doing is looking at some other asset classes. And so alternatives have been a part of the toolkit for us for many years. We have in our clients' portfolios, let's say, anywhere from and it depends per client, of course. Some have no alternatives, some have very high percentages. But let's say an average of between 20 or 30 and 40% alternatives. And I think that some managers and some strategies in the alternative landscape will be able to generate risk-reduced versus equity returns, and probably in the range of between 4 and 8%, consistent with equity-like returns.
Now, is there one particular strategy that you particularly like that you can name right now for this kind of environment?
It's not really one particular strategy. I mean, really, to me, in alternatives, you have long-short equity, you've got absolute return, you've got private equity, you have venture capital, you have just myriad different options. To me, it's really about the manager, and to me, it's really ferreting out a team or an individual or a group that via a process or enhanced research versus other people in our determination really has some type of edge. And that edge can be in any of those subcategories within alternatives. So for me, it's really trying to find, let's say, a firm that has been able to demonstrate over a long period of time preservation of capital, but also ability to generate alpha and generate positive absolute return, and that their view of how they want to position their portfolio is consistent with our view of the world. And there are great managers across the different subcategories of alternatives. And for me, it's much more about trying to, marry our clients with the people who I think are the most talented, rather than focusing on a strategy.
So it sounds like this is not a do-it-yourself kind of thing. It's don't try this at home. It really requires somebody with a fair number of assets under management, as you have, to find these top managers. One shouldn't just jump into a hedge fund or a private equity firm just because you can.
I think that you have to be much more careful in the alternative space than you do in the traditional space. The likelihood of a large cap equity manager drastically underperforming an index is somewhat remote, right? So if the index, let's say, is up 8%, a large cap manager probably is going to be up between 6 and 12%, right? Something like that. It would be rare that a large cap manager, if the index was up 8%, would be down 5%. It would be very common. If the hedge fund index was up 5%, you could have a hedge fund manager down 5%. So I think that, as you kind of phrased it, and I like the way you phrased it, it's not something you want to jump into without experience. I think you want to have a quarterback on that team helping you with that process, and someone who's been doing it a long time. I mean, I think that, we've been doing this for 20 plus years. There's a lot of knowledge that you gain over that period of time from making mistakes, from having successes, and knowing what questions to ask. And I just think that, again, the alternative space, you want to tread gingerly, not to be scared of it, but simply to make sure that you're in, I think, experienced hands, because there is more disparity in returns, and obviously you want to minimize the downside risks.
A good warning in volatile times. Thanks,
Yes,
Brian.
thank you so much.